Hello everybody, welcome to the Market Board. My name is Dave and today we're taking a look at Penn National Gaming, stock ticker PENN. Let me first start by saying though, I am not a financial advisor, but rather I am an individual investor. My research starts with the 10K, 10Qs, income statements, balance sheets, and cash flows, and then I work my way out from there. With that in mind, let's now transition to finding out just who the heck Penn National Gaming even is. Now, according to their most recent 10K, they are a leading, diversified, multi-jurisdictional owner and manager of gaming and racing properties, retail and online sports betting operations, and video gaming terminals known as VGTs. Now, one thing worth mentioning right off the bat, in my opinion, is knowing that in February of 2020, the company acquired 36% of Barstool Sports, a leading digital sports and entertainment and lifestyle company. Barstool Sports will thereafter exclusively promote Penn's retail sports books, iGaming products, and online sports betting products, including Barstool Sports mobile app, in combination with Penn's loyalty program, My Choice, that currently has over 20 million members and provides them with various benefits including complimentary goods and services. Their growth strategy outlined in their most recent 10K involves evolving from being an owner and manager of gaming and racing properties into becoming an omni-channel provider of retail and online gaming, live racing, and sports entertainment. To give you a better idea of the scale of the business, as of December 31st, Penn owned or managed 41 different properties in 19 different states, and if you're really curious, most of those are tied up in triple net leases, which basically just means that Penn agreed to pay property expenses such as the real estate tax, building insurance, and maintenance, as well as utilities, but that's in exchange for lower rent charges. They face very strong competition in the way of traditional gaming infrastructure, newly formed digital gaming infrastructure, and even state-sponsored lottery revenue programs. The stock is currently trading for about $71.25 a share, posting a market capitalization of about $11.2 billion according to finviz.com. Let's now transition over to their management team, starting with their CEO, Jay Snowden, who led the company's successful margin improvement plan, as well as the acquisition of Pinnacle Entertainment, which nearly doubled the size of Penn National. In January of 2020, Mr. Snowden assumed the role of CEO, and one of his first actions as CEO was to acquire a minority interest in Barstool Sports of 36%, but if you stick around, I'll tell you why that's going to increase even more later on. Next up, we have Felicia Hendricks, the CFO, who used to be a managing director and equity research analyst at Barclays, and before that, she used to be with Lehman. In my opinion, she's very likely to create some good shareholder value. Next up, we have Todd George, the Executive VP of Operation. Todd oversees Penn's regional operations, marketing, and information technology, as well as design and construction. Todd also recently played a critical role in integrating Barstool Sports brand with Penn core business. Prior to this, he spent 12 years with Pinnacle Entertainment, which was acquired by Jay Snowden. And finally, we have John Kapelips, the VP of Interactive Gaming. He oversees Penn National Gaming's interactive gaming strategy, including Barstool Sportsbook and HollywoodCasino.com. John led the new business team for Comcast Corporation with a focus on generating growth from new markets and industry verticals, and he was even the head of business development for the World Poker Tour. Let's now use this as an opportunity to see how well they have scaled the business by examining briefly the various segments within the company. Penn appears to have broken down their company within 6 segments. Starting with the Northeast segment, they have 12 casinos, and just to name a few, they include the Ameristar East Chicago, the Greektown Casino Hotel, Hollywood Casino Bangor, and the Hollywood Casino at Charlestown Races. In the southern segment, which is composed of 9 different casinos, they have the First Jackpot Casino, the Ameristar Vicksburg, the Boomtown Biloxi, and even Boomtown New Orleans. Moving on to the western segment, it is much smaller with only 5 casinos, but they include the Ameristar Blackhawk, Cactus Pete and Horseshoe, and the M Resort. In the Midwest, they have 8 different casinos, and to name a few, they include the Ameristar Council Bluffs, the Argosy Casino Riverside, the Hollywood Casino Aurora, and even Hollywood Casino Joliet. And their final casino segment is labeled Other, composed of 4 different ones, which are the Freehold Raceway, Retama Park Raceway, Sam Houston Race Park, and Sanford Orlando Kennel Club. And the final business segment they have is Penn Interactive, and that includes their gaming division that operates their online sports betting app called the Barstool Sportsbook and iGaming platforms that are currently available in Pennsylvania and Michigan. And the 16 internally branded Barstool Sportsbooks are currently available in the following states: Colorado, Illinois, Indiana, Iowa, Michigan, Mississippi, Pennsylvania, and even West Virginia. Now, Penn's business is quite literally speculation, and clearly their accomplished management team has scaled it quite impressively. What we're interested in knowing as investors is how well they've monetized it. Starting with their revenues, Penn reported in 2018 a revenue of about $3.6 billion, and that grew 47% in 2019 to $5.3 billion, but that declined 32% last year in 2020 to about $3.6 billion again. I think it's worth mentioning that this is obviously due to COVID-19's global impact, and I don't think that we should count it too much. Moving on to their gross profit, in 2018, the company reported a gross profit of about $1.5 billion, which was a gross margin percentage of about 42.9%, growing in 2019 to $2.4 billion, and the gross margin percent also climbed to almost 2% to 45.3% before declining in 2020 to $1.7 billion. But we do notice that the gross margin percent once again climbed, which means that they scaled up efficiency. Moving on, after expenses, we can measure their net income, and we see in 2018 the company reported a net income of $93 million that decreased by over 50% in 2019 to just under $44 million before going entirely red in 2020 with a loss of almost $700 million. Much of that was attributed to the loss of revenues due to COVID, but I still think it's worth mentioning. However, something did catch my eye of significant interest when comparing SG&A costs to top competitor DraftKings. In 2018, Penn National Gaming reported that they had SG&A cost that was equivalent of 40.2% of their gross profit. In 2019, that number increased 11% to 51.8% of gross profit, and then in 2020, that increased an additional 15% to 66.7%. Normally, I look for consistency, and that was alarming to me, so when I compared it to DraftKings, I found something even more startling. In 2018, DraftKings' SG&A costs were actually 143% of the gross profit. In 2019, that number increased 20% to 166.7% of their gross profit, and in 2020, it just went bonkers to 414% of their gross profit. What this means is that if growth were to slow, that would indicate an additional economic risk for DraftKings, not so much for Penn, I don't think. And I think it's also worth mentioning that Penn has around 4 times the revenues of DraftKings and a higher gross margin, but they have a fraction of the market cap. I'm not discounting DraftKings here, I'm just pointing out in comparison that they just need to sustain their insane growth, and in fact I think you should check out my video on them right now. But if you decided to hang around instead, we're going to cover institutional ownership, starting with the top holder, Fidelity, who holds about 13%, BlackRock has about 10%, Vanguard has about 10%, BAMCO has 7%, and Invesco has 5% as well, for total institutional ownership coming out to about 88%. Let's now take this opportunity to transition over to SWOT analysis to recap what we've discovered. In the way of strengths, they have an experienced management team. They are a leader in sports and gaming entertainment, and they've done a great job with the vertical integration of Barstool Sports, in my opinion. In the way of weaknesses, they did have a declining revenue last year in 2020, a growing net loss, and I believe, in my opinion at least, they're behind digital competition in the iGaming expansion as far as DraftKings is, at least. In the way of opportunities, though, additional states are going to open up for iGaming and sportsbook offerings. D1 athletes are now signing partnerships with Barstool now that that's legal. And number 3, additional acquisitions. They have almost $2 billion in cash in hand right now. But let's be very honest here, they do face many threats, including strong emerging competition. We could potentially see a reduction in consumer spending, and currently they have significant portions of their revenue coming from very specific properties which are tied up in those triple net leases. However, let's take this opportunity now to cover my take and my position. My position is that I have purchased the January 22 $75 strike calls. I wanted to use less capital to enter the position while maintaining a large upside with the NFL season set to begin in just 58 days, baby, from the time of this recording. I believe that Q4 is actually the strongest performance time for sportsbooks as they see increased activity via wagers between the NFL and their playoffs, the NBA, and the NHL during this time period, as well as any end of the year combat sports event. Think like a massive UFC fight or a boxing event. Additionally, I'm a huge fan of the acquisition of 36% of Barstool Sports, but mostly because I read the whole contract, and it states that quite clearly that Penn has the authority to obtain 50% of the company, and that the price that they pay is based upon the initial investment, not upon the appreciation of the business. That could create some serious value for shareholders if Barstool continues to develop and Penn acquires more at a discounted rate. But hey guys, just as one final reminder, I'm an individual investor. I'm not a financial advisor. This should not be considered financial advice. My name is Dave, and this has been The Market Board.